Hi, everyone. Welcome to this week's, or I should say this month's, Coping with COVID session. Today is September 14th, and we have shifted these from weekly meetups to monthly meetups, basically to account for the fact that there is not a ton of new information coming out right now. So we all just continue to cope with what is becoming our new normal and figuring out what that is and how best to support each other. For those of you that don't know me, my name is Elaine. It's lovely to see you. I am a CPA with a personal financial specialist designation, and I am an accredited financial counselor. And I have the great privilege of working with creative individuals and groups all across the country to help with the business side of creativity. I am incredibly fortunate to be doing this work and to continue to be doing this work with lots of groups who are working to support the creative community right now, because as you know, it is a tough time to be a creative individual. Everything we talk about in these sessions is for educational purposes only and should not be construed as tax, legal.
No.
But you probably knew that. We will be talking about some of the questions that came in. Thank you for putting those into your registration form when you signed up for today. It always makes it more interesting when we can talk about questions that are top of your mind right now. And if you have additional questions as we're going through any of this information, definitely feel free to use the chat feature in Zoom. If you hover towards the bottom of your window, there's a little chat icon. You can click on that and then type your message into the chat, and you can send it either to everyone or to me privately, and then I'll make sure to address your question as we're going through this. More specifically, other than just talking about money stuff, we want to go through some details of the FEMA unemployment extra dollars that many of you may have started to receive, and also the payroll tax pause that was initiated by executive order a few weeks ago. There are new per diem rates coming into effect on October 1st, and as you start planning for next year, it's kind of optimistic perhaps to think about what travel might look like, but I do want to make sure you're aware of those. And then we'll talk about changing your rates during this time and whether or not that makes sense. And then also address a really interesting question that came up about foundation funding. So, as you probably know, both the House and the Senate have passed different versions of a second stimulus bill to help with the ongoing economic uncertainty and the recovery. There are a lot of differences between those bills, and the House and the Senate have not yet figured out how to reconcile those differences. And then the Senate talked last week about what they were calling a skinny Senate bill that had sort of some pared down versions of aid and assistance. That didn't go anywhere. It is considerably smaller than the original Senate bill, and because it didn't really go anywhere, it doesn't make sense to spend a whole lot more time talking about it. Now, as we think about the fact that that did not go anywhere, the natural next question is, well, so now what? We have these unreconciled bills, we have legislation that's not going anywhere, and we have a lot of disagreement among our elected officials. So what's going to happen? And the short answer is, I don't know, and frankly, no one knows, but some people might know slightly better than I do. There are some potential options. It is possible that Senate and the House will come together and agree on some sort of common relief bill. I don't know what the likelihood of that is, but that is still a possibility. It's also possible that there may be some smaller, more targeted relief efforts. There is some overlap between the House version of the bill and the Senate bill, so it's conceivable that our legislators could approve small portions of the bill and put forward a series of different relief efforts. It's also possible that there could be additional executive orders that come into play that address one or more aspects of some of the relief. And of course, it's possible that nothing will come to fruition. As you know, we are in the midst of an election cycle, and it is certainly within the realm of possibilities that nothing will happen until after the election. But let's see what happens. Now, I mentioned those executive orders. The original sort of tranche of executive orders were signed in early August. Those continue to move forward. Some new states have been added to the list of approved states to get some of that FEMA relief money. FEMA is out of money for that, effective this week. And then the IRS has also shared some guidance on that payroll tax pause. So let's dig into that. First of all, the big question is FEMA giving you money? So it depends. This program was signed into law via executive order, which is allowed because President Trump essentially took some dollars that Congress had already apportioned for emergency relief and moved them over to emergency unemployment relief through FEMA. The program is called the FEMA Lost Wages Supplemental Payment Assistance Program, and essentially it sends $300 of federal dollars to states for them to add to existing unemployment checks that individuals are getting. So if you are an individual who is drawing unemployment, and if your weekly check is more than $100, then you will probably get some of these extra dollars. All states except for South Dakota have opted in and been approved for participation. Guam and the Virgin Islands have also been approved from FEMA. So the good news is if you are getting unemployment through one of these states, and your check each week is more than $100, then you will get this extra $300. You may also get $400 instead of $300 if you live in a state that has added their own sort of matching dollars to the mix. States were strongly encouraged to do this, but not all states had the resources to be able to do that. The key point in that, though, is that individuals have to be drawing $100 per week in unemployment, and that's not the case for all individuals in the country, and certainly not all creative individuals, because depending on how your state calculates your unemployment benefit, your weekly benefit could be less than $100. So this is not helpful for you, and I apologize for that, but if your weekly check is more than $100, then you're getting a smidge more. As I mentioned, almost all states and territories that have applied to participate have been approved. South Dakota decided they did not want to participate since their unemployment rate had recovered to more or less pre-pandemic levels. And these other states have started to send out dollars, which is great. The downside is that depending on how exactly you calculate the dollars and the math, this program is going to be out of money at some point this week. So if you have gotten dollars already, that's fantastic. If you have not, but you think you might be owed them, that check may still be coming. But after this week, there won't be any more money left in that program, which is tough, because that means even for individuals that did have this additional supplement, now that is going away as well, and there is no news or legislation on the horizon that seems to be ready to replace it quickly. Now, if you still have a W-2 job, you may be affected by this payroll tax pause that was also enacted via executive order at the beginning of August. So what this means is if you have a W-2 job, when you get paid, your employer withholds 6.2% of your check for Social Security. They also withhold some for Medicare and for your federal taxes and state taxes and local taxes. None of those things are affected by this executive action. We're only looking at the 6.2% that's being withheld for Social Security. So under this executive order, employers will no longer withhold that amount, but the employers still have to pay their own share. So if you are someone with a W-2 job and your annual salary is less than $104,000, you may see your paycheck go up a little bit because your employer may not be withholding your Social Security tax. The bad part about this is that this is not totally forgiving the tax. It's just deferring it until January, February, March, and April of 2021. So that means you are not paying the tax right now, basically for September through December of this year, but you will be paying double the tax starting next year to make up for the underpayment right now. So what this looks like in real dollar terms is if your normal take-home pay is $1,300 or just under $1,400 or so, calculated based on your regular gross pay minus everything that's withheld, for the next 4 months, your Social Security tax will not be withheld, which means your take-home pay is going to go up a little, which feels very exciting because people could really use some more dollars right now. But the big problem with this is that next year in January through April, your take-home pay is going to go back down, not just to its normal level, but it's going to go down below its normal level because your employer will need to make up that withholding starting in January of 2021. Which is a big problem because anyone whose paycheck is barely covering their expenses will be really affected by this, especially when January hits, which is a time when many individuals have larger than normal bills sort of left over from the holiday season. So this is confusing and a real pain. There are still a lot of questions about this program that have not been addressed. One of the common questions is, can I opt out of this? Like, what if I don't want my employer to do this because I want to just keep getting paid my normal amount and not worry about it? The answer to that is no, the individual cannot opt out. This is an employer level decision, but you are welcome to talk to your employer, the payroll office or the HR office, and say, hey, I'd rather you not participate in this, and see if you can affect their decision. I will tell you, I am a college professor and our institution decided not to participate because they felt like this was going to hurt workers over the long run, and a number of large employers have made a similar choice. So it's very possible that your employer has already decided not to participate. Again, because it's not necessarily better for the workers long term, it's just changing the timing of when they're paying these taxes, and that's not necessarily helpful. It is possible that Congress could decide to make this a permanent change. So instead of just deferring collection of Social Security, they could permanently forgive collection of Social Security for this 4-month period. That is certainly possible. I don't know that that's going to happen in the next couple of weeks or so. So it's not something I would necessarily count on. So if your employer is participating, I'd be careful not to spend these extra dollars and rather just save them so that you can have them ready for when your take-home pay goes down starting in January. The other question that has come up associated with this that Treasury and the IRS haven't really been able to answer yet is, what happens if you change jobs? So let's pretend you're working through December and your employer is participating in this, but then let's say you change jobs or no longer have that job starting in January. How would the IRS go about collecting those extra dollars from you? We don't have a clear answer. My guess is they will eventually be collected through your annual tax filing process. So on your regular Form 1040 that you file each year, but that's going to be confusing and it's going to be kind of annoying. The other potential complication is, because this is happening at the employer level, what happens if you have a job this year and your employer doesn't participate, and then next year you take a job with a different employer and they have participated? Are you going to have then that extra withholding without having benefited from not having withholding in the end of this year, which is also possible because this is not being enacted at a person by person level, it's being enacted at the employer level. So all of this is to say, it feels like a potentially good thing to put more dollars into people's pockets, but this is a really convoluted and messed up way of doing it, and it's not actually helping anyone. So my hope for you is that your employer will not participate and you will just keep collecting your normal take-home pay and making really smart financial choices. If your employer is participating, my hope is that you will save those extra dollars and hang on to them so you don't find yourself in a sticky situation next spring. So that's the payroll tax situation. The other interesting thing that's coming up lately is all about travel expenses, which sounds kind of silly because most people aren't going anywhere right now, but that's exactly why people have started thinking about these things. For some artists, especially if travel is normally a big part of what they're doing, they're looking at their income and expenses so far for the year, and they're realizing their expenses are quite a bit lower than normal. Now, for some of them, that works out well because their income is also quite a bit lower than normal. But if you are someone who is still collecting your kind of regular amount of income, maybe your work has just shifted into a virtual setting, or maybe it hasn't really been interrupted all that much, right? You might be in a position where your net income is going to be higher than you thought it was going to be. And this would be the case if your income is basically staying the same, and then instead of being able to deduct all those ordinary and necessary travel expenses that you normally have, now those have gone away essentially for you. So that means your net income, the amount you pay taxes on, is going to be a little bit higher. And that means you pay more in taxes, and that's going to be a challenge for some people, depending on how much they have set aside to cover those tax obligations. So I would encourage you, since we're in September and there's still some time left in 2020, just take a peek at kind of your numbers to date and see if you think your net income is going to be about on par with where it was last year, which would be great, or if you think it's going to be a little bit higher. And if it is going to be a little bit higher, go ahead and start doing some kind of back of the envelope math to see what that means for your taxes. Because if you're going to have net income that's a little bit higher, there are some things we can do now to start planning for that. Number one, you can take advantage of some of that cash flow if you wanted to contribute to your IRA, or maybe if you have a SEP IRA for your self-employed income, that both of those actions could help lower your net income and then your tax obligation, which is not a bad idea. Or if you wanted to take advantage of other expenses that you might have on the horizon, maybe it's time for a new computer, or maybe there are other expenses that you could make sure to incur this year. That is not a bad idea. Lastly, if none of those are options for you, you can just start saving a smidge more to cover those tax obligations. All of which is to say, this is a really delightful problem to have, and thinking about what to do with this problem right now is not a terrible strategy. The other interesting thing that came out related to tax expenses recently, on Friday, the IRS released the per diem rates for the next fiscal year. So these start on October 1st. So if you are someone that generally charges individuals or clients based on these per diem rates, know that they are changing going forward. So go ahead and pull up the most current rates for wherever you happen to be going. These would be breakfast, lunch, and dinner per diem rates, but then also lodging rates in various cities across the world. Typically, this comes up for writers, especially playwrights who might be traveling to different locations for productions. It also comes up for actors and musicians and other performers that often have per diem compensation built into their contracts. So just make sure you are reflecting the most recent information. Now, one of the questions that came in when someone registered was, should I lower my rates during COVID? We are at this strange moment in time, and should I, as a creative individual, be thinking about lowering my rates? And I love this question. My general answer is no, although it comes with a caveat. So whenever we talk about kind of what you should be charging for your time or your services or your goods, we always think about the value you're providing being informed by four different things. You have your costs, your customers, your competition, and your competencies. So if we step away from the global pandemic for a moment and just say, okay, what of these have changed, we can go through each one and start analyzing to see if the value of what we've done has changed and if our rates should change accordingly. So the first thing we would look at are your costs. Some of your costs may have gone down, especially if travel is a big part of what you do, but other costs you have may have actually gone up. You might be spending more on cleaning supplies or protective equipment. You might be spending more on shipping instead of delivering products live to your customers or clients. You might be spending more money on subscription services like to Zoom or other digital platforms to enable you to continue doing your work. So first, look at your costs and see if they have changed. But of course, costs are only part of the equation. The most important aspect of you delivering your value are your competencies, the things that make you the most special, capable person of doing what you do. I would argue that these probably have not changed at all, regardless of what's going on. You still bring the same skills, experience, expertise, perspective to your work that you have always brought to your work. And that perspective or experience may have shifted this year, but you are continuing to provide it as part of the value you provide. So your competencies probably haven't changed at all. If anything, they've probably gotten better as you have navigated sort of these crazy conditions and figured out how to cope with them. It is interesting to think about what your competitors are doing. We are in a world right now where some individuals are offering things for free. And if they are your competition, that impacts what your customers perceive as the fair price for what you are doing, right? So be aware of what your competitors are doing. Not all of them are offering everything for free, but there is a lot of free content out there right now. And so you have to consider that as part of deciding how you are going to set your rates. So check in with them, see who they are. You probably should already have a sense of who they are, but if not, do some digging and figure out maybe who your top 5 competitors are and see what they're doing, how they're adapting, if their rates have gone up or down right now, and just be informed by that information, because it's important that you understand what's going on and what others are doing within the industry. That doesn't mean you have to do the same thing, but you do have to know what's going on so that you can explain any differences you might have. And then lastly, think about your customers. How have they changed, both in terms of what they are willing and able to pay, and also in terms of who they are? It is very possible that you are serving different customers right now than you were serving a year ago. That could be a very good thing if there are no geographical boundaries anymore and your customer base has increased. It also could be more of a negative thing if all of your customers have sort of disappeared or are focusing on other things right now. So it's important to spend some time understanding how your customers have changed, and also how their willingness and ability to spend money on things has changed. Some of them might be more willing than ever to spend money right now. I'm hearing that, interestingly, from a whole lot of visual artist clients. And it's tapered off a little bit, but especially in, say, June and July, a lot of visual artists, particularly those who have work that is very accessible to individuals, they were finding they were doing really well because individuals were interested in making sure their homes were very comfortable, or they had nice work on the walls, or their backgrounds for all these digital meetings were up to par, right? So a lot of visual artists found themselves being busier than normal right now, which is a really good thing. Other visual artists have been struggling tremendously. Some of our muralist friends, especially those who work with corporations or hotels or other sort of large spaces, they're struggling more so right now. So think about your own customers, how they've changed, and whether or not their willingness or ability to pay has changed, and let that inform your pricing strategy as well. But none of these factors are sort of overwhelmingly conclusive, right? You have to think about them all holistically and understand how your costs have changed, how your customers' perception of your work has changed, how your competitors have changed or have not changed, and how your competencies have changed or stayed the same. And by considering all four of these things, that can guide your conclusion about whether or not you should be charging more or less for what you're doing, or making no changes at all. I'd also encourage you to think about figuring out ways to capture the value you're creating through your pricing structure. Maybe this means you have some sort of sliding scale pricing option. This might make sense if a lot of your customers have been severely financially impacted by everything that's going on right now. Maybe then you offer some sort of sliding scale payment option. That certainly is possible. It's also possible to do sort of a free version of something and then a premium version of something. It's also possible to continue to serve your existing customers while also reaching out to new customers, maybe those who have been less affected. But I would challenge you to think about kind of the how part of capturing the value rather than just deciding to discount everything by 20% and then calling it a day, because that's not really going to help you sustain anything long term. So great question. Thank you for adding that to our registration list. The next question that came up that I thought was just fascinating, someone asked, who can change the 5% foundation distribution rule? Which is a really, really interesting question. And it gives me an excuse to pull up some tax code legislation, which I absolutely love doing. So thanks for that. But basically, this question is getting to what's covered in section 4942 of the Internal Revenue Code, so tax law. And this piece of the tax code basically says private foundations have to distribute 5% of their non-charitable use assets every year, or they have to pay a specific tax, like an excise tax, right? So that's a technical way of getting to the end result, which is foundations spend 5% of their assets every year in funding, generally speaking, other nonprofit organizations, but it could be anything that meets the standards of what they were set up to fund. So this person's question is, who gets to change this rule about 5%? And the short answer is Congress, right? Because Congress is in charge of setting tax law, and tax law is codified in the Internal Revenue Code. So any changes to tax law come from Congress, right? Now, we all know the likelihood of them changing this particular aspect of tax law right now, I would say, is very, very low. I would not hold your breath on that, certainly not in this year. What is interesting, though, is even if tax law doesn't change, foundations can choose to spend more than 5% of their assets. Because remember, the way this particular provision is written, there is a penalty imposed if they spend less than 5%, but there's nothing that says they can only spend 5%. So it is certainly possible that foundations might say, you know what, this is a really good year to spend a little bit more than we might normally spend to help organizations that are in distress. We might see this happening for foundations that support performing arts companies or theater companies in particular. A lot of the news that has come out over the past couple of weeks is really dire for that segment of the arts economy, especially as we look at maybe a full season of selling theaters at 30% of capacity or less, and understanding what that will do to the theater industry long term. So could foundations choose to spend more? Absolutely. Will they? Who knows? There's complicated math that goes into that because most foundations have this pool of assets. And if you spend it down too quickly, then that pool of assets won't necessarily grow and continue to be available to support things over the next 30, 40, 50 years. We see something kind of similar with the endowment math for organizations, and it's tough, right? There is a strong argument to be made that you can spend more than what might be considered sort of the minimum in times of crisis, but there are long-term implications of that as well. And so the organizations themselves, the boards, everyone in charge of these private foundations is probably making complicated choices and doing complex calculations about what they can be doing to support the organizations they love and support on a regular basis. Something else they could do, and we have actually seen a lot of foundations do these things, is they can give away money that is less restricted. Organizations right now, and individual artists and anyone who is in receipt of grant dollars or any sort of contributions, they benefit from those dollars being as unrestricted as possible. So if I were a foundation and I were giving money to a ballet company, I might say, here, in a normal year, I might require you to spend this on your fall performance, but this is not a normal year, so just here, take the money, spend it on whatever you need to spend it on to maintain the organization. That would be a wonderful thing for foundations to do right now, and we have seen a lot of foundations have loosened up some of their restrictions. We could also see foundations giving organizations more flexibility to spend dollars over multiple years. Way back in March, which feels like it was eons ago, when organizations, especially performing arts organizations, started having to cancel shows, many of them were nervous that the foundations that supported those shows would not be able to continue to support them because they could not pay performers for those shows or pay the venues for those shows or anything like that. So we saw foundations loosening some of their restrictions so that instead of requiring organizations to spend dollars by June 30th or another date that coincided with the end of a fiscal year, they relaxed those restrictions and let the organizations spend those dollars over multiple fiscal years if it made sense for them. And we also saw a lot of foundations loosening some of their reporting requirements. So organizations didn't necessarily have to submit full, complete reports about everything they used the dollars on. They relaxed some of those reporting requirements, which took a lot of pressure off of organizations, which is good because organizations were trying to figure out how to apply for PPP funding and whether or not they needed EIDL funding or any of these other programs. So those were all good things that the foundations, many of them did. And my hope is we'll continue to see some of that flexibility going forward. So I hope that answered the question. It was a fantastic question. And again, anytime I get to pull out some tax code, it's always a good day. So those are basically our highlights from today. FEMA unemployment is still a thing in all states and Guam and the Virgin Islands, except for South Dakota. However, that program is rapidly running out of dollars, so it will not be a thing for much longer. There are some new per diem rates, so if you travel, make sure you're paying attention to that. And if travel expenses are normally part of your deductible expenses each year, and you're not going to have a lot of those this year, maybe take a peek at what your net income is going to look like so that we can start strategizing for ways to keep that down this year so that we can put some dollars to different or better use. And then we touched on changing per diem rates, but then also foundation funding, and then also changing your pricing rates for your work and whether or not that makes sense for you. So those were all the questions that have come in. I don't see any more in the chat, although I see one of our friends is juggling online school as well as everything else. So kudos to you, Brian, for handling that. I think that's absolutely amazing. So with that, I will go ahead and close us out for today. Thank you so much for your questions and for listening. I hope you are all doing well. If you are on the West Coast, my heart is going out to you. I know you are dealing with a whole lot right now, the fires fires and the destruction are absolutely atrocious, and know that we are thinking of you. And then if you're in the Gulf region, I'm pretty sure I saw a headline that another hurricane is headed your way. So we're thinking about you as well. Keep supporting each other. It is a brutal, brutal time to be doing what you do. And I am so glad you continue to do it, because it is so important that we continue to have arts in the world. And with the money side, I am happy to keep doing that. So have a great rest of your day, and I will see you next month. Thanks, everyone.